Hello and welcome to FT Markets. Violence in Ukraine has escalated this week and bond investors have taken fright. Ukrainian bond yields have soared and the currency's come under increased pressure despite the central bank's efforts to halt the slide. With me to discuss the developments in Ukraine is Gabriel Sterne, an economist at Exotix. Gabriel, thank you so much for being here today. There's lots going on in Kiev, of course, and there's been protests running for now 3 months. And this week things have turned a little bit deadlier and clearly the markets are selling off. What are people worried about here?
Well, I think obviously politically Ukraine is in a very difficult situation. And in a sense the markets are focusing on a knife edge that just mirrors the way that the politics is going. And really what the key issue is can Ukraine find a backstop from somewhere, be it from Russia or the West or the IMF? Meanwhile, reserves are gushing out. And the key question is, can they survive really till a post-election IMF program, which is, I think, everybody's baseline, or whenever the election would be?
That's true. I mean, even that is uncertain now. I mean, Ukraine did receive a $15 billion bailout, in tranches, of course, from Russia last December. I mean, it's getting that money drip by drip, but is a concern here that, frankly, it somehow muddles its way into a sovereign default even?
Well, I mean, it's a classic liquidity crisis. So Ukraine's debt to GDP ratio is 40%-ish, so it's really not a solvency problem yet, but it does need to get this money from Russia or somewhere to keep it alive for the time being. And that, in fact, its liquidity crisis creates a funding knife edge because if bond yields go down below 8%, for example, which they did briefly when they got the announcement of the Russian aid, Ukraine could just issue as much as it wants, problem's gone away. But at the moment, bond yields, 10-year bond yields are above 10%. It's really too expensive for Ukraine to issue. That is the nub, and so that's why markets are very focused and very volatile and very sensitive to every single news event.
Yeah, I mean, the hryvnia has approached 9 to the dollar now. Obviously, the central bank has done a fairly decent job of trying to keep the rout contained. Is a concern here that escalates into a currency crisis and the full balance of payments crisis then?
I mean, there is indeed a concern, and although the central bank is doing what it can with capital controls, you know, arguably it would have been far better if they'd done the same thing earlier. I mean, Ukraine actually needed a currency depreciation, and the International Monetary Fund have called for one. The question is, can they put a lid on it? Now, 10%, 15%, probably that's okay. Once it gets to 20, 30%, then the problem is that a lot of the corporates have dollar liabilities. They could face solvency problems. That could bring the banks down. Then you start to look at a sovereign crisis.
I mean, Ukrainian bond yields are above 10% now, and of course there aren't that many countries that can offer investors those kind of returns. I mean, would you buy Ukrainian bonds at this level?
Well, everything I've said, actually I would buy Ukrainian bonds at this level, simply because if you think about the pricing of them, which yesterday was around 83 for a 10-year bond. Now, as I said at the start, it's not a solvency crisis yet. Debt GDP ratio of 40. So what haircut could you ever get? What's the worst they can do to you? Say the worst you could get is a 33% haircut. So the lowest the bond price can go is 66. Now, so you're 83, lowest is 66. The highest is well above 100 if things get sorted out. So, you know, you're closer to the low than the high, and still I think the odds on that this gets sorted out one way or the other. So yes, I would be a buy just based on the balance of probabilities.
Okay, well, thank you very much, Gabriel. Thanks for being here today.